First, I think that the cyclical recovery is still on track. The business cycle is still supportive. So we do expect growth because we do observe that there is no excess in the business cycle. No excess in terms of production, no excess in terms of inventories building, no excess in terms of investments. So I think that the growth momentum is still on track. Nevertheless, we do leave the acceleration phases and we're gonna to be in a more usual growth cycle. In terms of data, what does it mean? It means that this year the growth in the Eurozone would be around 2%, slightly less. Next year we do forecast 1.6%, and in 2020 we think that the growth will be around 1.4%. So the main message is that we do expect still growth, even if it's a more usual growth number. So you're right. The first risk is a world trade war with retaliation, and you can include in this economic risk the Brexit. So this is the first risk, and the second one, I think, this is wage data. For the time being, you have wage increase in all developed countries. For the time being, it supports consumption, and it's positive because if consumption is okay, when you are a corporate, you remain confident and you can carry on producing and investing. But when you look at some surveys, there is a risk that wage data are higher than expected. And in that case, either corporate absorbed those wage increase, and in that case it will reduce corporate profitability and you might have a slowdown, or you might expect a wage increase. Corporate are transferring those wage increase in inflation, in price output. You might have central banks that are supposed to tighten more than expected, and as the financial market and particularly risky assets are so vulnerable to any interest rate increase, you might have a sharp slowdown in stock market, equity market, and a negative wealth effect. So if I sum up, I think that one of the main risks is wage data. In Groupama Asset Management, we do think that we will remain in an environment with low interest rate for a considerable period of time. Nevertheless, for the coming month, we forecast a slight increase in long-term interest rate, particularly because the Fed is supposed to carry on the deflation of its balance sheet. So we expect a slight increase in term premia, and so slight increase in long-term interest rate. In such environment, okay, we are slightly cautious on bonds. On the other side, as we expect growth, that means it's still positive for profits in corporate, and so it's still positive for the equity. So if I sum up, I think we slightly prefer equity to bonds for the time being and for the next quarter. For the time being, we still remain positive on the US stock market. And that's very important, how to balance between two countries. In all countries you have imbalances. But what is key is that do we observe in a country the ability to solve the problems, the ability to solve the challenges. And for the time being, okay, in Europe, we remain cautious because we need to admit that there is a lack of governance, a lack of policy mix between monetary policy and fiscal policy. So it means that the Europe had probably less ability to solve problems than other countries. You guess, because if you remember my previous answer, that you guess that okay, no, we remain more positive on, let's say, US stock market than Europe. I can add that we remain cautious for the timing on emerging countries, particularly in an environment where the Fed is supposed to carry on its tightening process. The risk is slightly upward on the dollar, and in such environment, we prefer to remain cautious on the emerging markets. So definitely for the timing, we do prefer US markets.